Most people hear the phrase save 50% of your income and immediately dismiss it as impossible. They picture extreme sacrifice, no enjoyment, and a miserable life spent counting every cent. What actually happens when you study the people who do it is almost the opposite. They report higher life satisfaction, lower stress, and more genuine enjoyment of their daily lives than the people spending freely and saving nothing. Today you are going to see exactly how they do it, and why it is far more achievable than most people ever allow themselves to believe. Welcome to Rich Mind Daily. This is part 2 of our early retirement series. In part 1 we covered the 25x rule, the savings rate principle, index fund investing, and tax-advantaged accounts. If you have not watched that video yet, go watch it first, because everything we cover today builds directly on that foundation. Today we are getting practical. These are the specific strategies that take most people from a 10 to 15% savings rate to 40 to 50% without making their life feel smaller. Let us get into it. The housing decision that moves your savings rate more than anything else. Housing is the single largest expense in most household budgets, typically consuming 28 to 40% of take-home pay. It is also the single most impactful decision for dramatically increasing your savings rate. The standard financial advice recommends spending no more than 28% of gross income on housing. People aggressively pursuing early retirement typically target 15 to 20% or less. The difference between a household spending 35% of income on housing and one spending 20% is a 15 percentage point swing in savings rate from one decision alone. The strategies that achieve this are downsizing to a smaller space than you could afford, choosing a less expensive neighborhood than your income would qualify for, taking on a roommate to split costs, or house hacking by purchasing a small multi-unit property and renting the additional units to cover the mortgage entirely. None of these require permanent sacrifice. They require a temporary prioritization of financial independence over square footage and postcode prestige. The transportation strategy that eliminates the second biggest cost. Transportation is the second largest household expense in America, averaging $10,000 per year. For most households, this includes 1 or 2 car payments, insurance on financed vehicles, fuel, maintenance, and parking. The transportation decisions that most dramatically increase savings rate are driving a reliable paid-off used vehicle instead of financing new ones, eliminating a second vehicle where public transport or cycling is feasible, choosing a home closer to work to reduce commuting costs, and shopping car insurance annually rather than accepting automatic renewals. A household eliminating one car payment of $500 per month, reducing insurance from $200 to $120 by switching to a paid-off vehicle, and reducing fuel costs by 30% through a shorter commute immediately finds $700 to $900 per month of additional savings capacity. That single cluster of transportation decisions increases a $60,000 salary household savings rate by 14 to 18 percentage points. The income side. Why cutting a loan never gets you to 50%. Aggressive saving has a mathematical floor. You cannot cut below zero. At some income levels, reaching a 50% savings rate through expense reduction alone is genuinely impossible, without a standard of living that most people find unsustainable. This is where income growth becomes the essential complement to frugality. Every additional dollar earned at a constant spending level goes entirely to savings. A household earning $60,000 and spending $45,000 saves 25%. If that household increases income to $75,000 without increasing spending, the savings rate jumps to 40% instantly. The most accessible income growth strategies are salary negotiation, developing higher value skills in your current field, adding a part-time income stream in your area of expertise, and monetizing existing assets or knowledge. Research from Salary.com found that employees who proactively negotiate earn $5,000 to $10,000 more per year than those who accept initial offers. Over a decade, that gap compounds into $50,000 to $100,000 in additional wealth even before investment returns. Lifestyle design, spending intentionally on what genuinely matters. The people who successfully maintain high savings rates long-term are not people who deprive themselves of everything they enjoy. They are people who have deliberately identified the specific experiences and things that genuinely improve their quality of life and eliminated the spending that does not. Research from Cornell University psychologist Thomas Galovich found that people consistently overestimate the happiness they will get from material purchases and underestimate the happiness they get from experiences, time freedom, and relationships. High savings rate households typically spend freely on the 2 or 3 things that genuinely matter to them and ruthlessly eliminate spending on everything else. One person spends on travel and cuts restaurants entirely. Another invests in home cooking equipment and eliminates expensive gym memberships. The specific choices matter less than the principle. Every dollar spent should be a conscious decision that reflects actual values rather than unconscious habit or social expectation. The automation system that makes saving effortless. The most common reason people fail to maintain a high savings rate is not lack of motivation, it is the friction of making the savings decision actively every month. When saving requires a conscious transfer, it competes with dozens of other spending impulses and obligations for attention. When saving is automated, it happens before the money is ever available to spend. The automation system that works most reliably has 3 components. First, set up an automatic transfer to your investment account on the day your salary arrives, not at the end of the month after other spending has already occurred. Second, increase this transfer by 1% every time you receive a pay increase so the lifestyle inflation never has a chance to absorb the extra income. Third, automate contributions to your 401k or equivalent retirement account at the maximum rate your employer will match before touching your take-home pay at all. Research from the National Bureau of Economic Research found that automatic enrollment in retirement savings plans increases participation rates from approximately 49% to over 86% and significantly increases long-term savings rates. The environment you design for yourself is more powerful than the willpower you try to maintain. 5 strategies. Reduce housing costs below 20% of income. Attack transportation as the second biggest lever. Grow income alongside cutting expenses. Design your spending around what genuinely matters, and automate everything so the decision never has to be made consciously again. These 5 principles applied together are how ordinary households reach 40 to 50% savings rates and retire decades ahead of schedule. If this video gave you at least one concrete idea you can implement this month, hit the like button right now. Subscribe to Rich Mind Daily so you do not miss part 3 of this series where we cover exactly how to invest your savings to build a portfolio that supports you for the rest of your life. Drop a comment below. What is your current savings rate and what is the single biggest barrier stopping you from increasing it? I read every single comment. See you in the next one.